All right, in this video, we're going to cover how to place an option trade. Now, if you're familiar with buying and selling stocks, a lot of this will be familiar, or even if you just watched the How to Place a Stock Trade video. But there are a few elements that are different with options, and they're extremely important that you understand them before you begin trading. So let's start with what you're going to see when you go to your brokerage account and try to place your first trade. So on your order page, you're going to see a set of basically check boxes usually. Okay, and the first 4 or 5 of these, the same thing you'll see with a stock, but the last couple are different and they're unique to options. We'll go through them all. The first is the action. Are you looking to buy or are you looking to sell? So if you're getting into a trade, you want to buy that call option. When you're looking to take profits or get out, you're going to select to sell it. Next thing is the quantity. Now with stocks, you choose the number of shares. Whether it's 50, 100, 1,000 shares. With options, you're choosing the number of contracts. And remember, each contract represents 100 shares of stock. So if you're buying a $5 call option and you think, I want to invest $50, I'm going to buy 10 of them. No, you invested $5,000. Okay, so just remember that each contract's 1,000 or 100 shares, and you're choosing the number of contracts that you want to purchase or sell. Third is the order type. Is it a market order or a limit order? A market order is simply going to sell it at the current bid price or buy it at the current ask price. A limit order, on the other hand, is going to limit how much you pay or what you're willing to receive. Now, when it comes to options, whether we're buying or selling, I always suggest using a limit order. And the reason is they're generally more thinly traded and they have wider bid-ask spreads. Okay, so let's say you look at the stock and it's trading for $50 of the bid and like $50.05 is the ask. Very tight bid-ask spread, 5 cents. The option, on the other hand, might be trading for $5 is the bid and the ask is like $5.50. So it's like 50 cents wide, and of course times 100 shares, so that's $50 wide just in that little spread. So if you just place a market order, you're going to get the high end of that price. If you're buying a lot of options, you could get an even higher price if you burn through a few of those asks. So I always use a limit order, and I'll generally place it right in the middle of that bid-ask spread. So like I said, if we've got a bid at $5, an ask at $5.50, I'll usually place a buy limit order at maybe $5.25 or $5.30 and usually get filled within a few seconds. The fourth thing is the term. Is it a GTC or good till canceled order, or is it a day order? Now, day orders expire at the end of that market session. So if you don't get filled by the time the market closes that day, your order's deleted and it's gone. But a good till canceled order is just as the name implies. It stays on the broker's books until you cancel it. So especially if you're placing limit orders, you say, I want to buy this thing for $3. It's currently trading at $4. I'll place it GTC. It goes to $5, $6, $7, $8. You say, I didn't get filled, but you leave it there. The option could come back a month or 2 months later. You forgot all about that order sitting out there in the open, and one day you open your account and go, how did I get these option contracts? Because your order was placed as good till canceled. It was still out there. Now, there's nothing wrong with doing this. Just remember that it's there. And don't forget about it and wind up buying them 2 days before expiration as they go to zero. Now, the fifth thing is the ticker symbol, obviously the underlying stock that the option is based on. In this example, we use KO, which is Coca-Cola. The next thing is the expiration date. So each of these option contracts has an expiration. They have a deadline of when you can buy this stock by. And these expirations, they used to be just monthly. It was the third Friday of every month. So there was, a January of 2019 expiration, February of 19, March 19, et cetera, et cetera, et cetera. And each of those expired on that third Friday of that month. Well, now for some stocks, there are also weekly options. Generally, these are limited to the more heavily traded stocks, your Apples, your Netflixes, your Googles, et cetera. But they do exist. There are also quarterly options. But for the most part, you're just going to stick with the monthly options and choose the month and year of the expiration you're looking at. And then finally, of course, there's the strike price. At what price are you entitled to buy that stock? So these are all the things you're going to check. Now, you don't have to go through and do all of this manually because almost every brokerage platform is going to offer what's known as an option chain, and it looks like this. So when you set up your account, again, tell them you want to buy call options. So they'll give you like level 1 option clearance. A quick piece of advice from a former broker. There's a weird thing with brokerage houses where they have to ask you if you have any experience with it. And it's like you need experience to allow you to trade them. But how are you going to get the experience if they don't let you, right? Some of the things. So all I'm going to tell you is they don't check on whether you really have experience or not. Okay? I'll throw that out there. Now, this is what the option chain looks like. So, you'll go select your stock, again, Coca-Cola in our case, bring you to the option page. You'll select your expiration month, in our case, December 2018, and it'll bring you this, which is the option chain. Okay, it's going to show you at various strike prices what the calls and puts are currently trading for. If you stare at this thing, you'll see them move around 5 cents, 10 cents at a time. Some people have screens full of this stuff until their brain is mush. But this is what will show you where various options are trading. So when you go to this in your brokerage account, again, just click the option page, enter your stock, choose the expiration month, and all this will auto-populate. So in our case, we were looking at the $50 call. So calls are over here on the left. We want the $50 one. And that's that one right there. So we see it has a bid of $5. That's what buyers are currently willing to pay. There's an ask of $5.25, what sellers currently want. So if we wanted to buy this thing right now, we'd probably put a buy limit order in at around, $5.15. But instead of having to do on that previous page where you fill out all the little drop downs, you can usually just right click on this, click buy or sell depending on what you're doing, and it'll auto-populate your order form. You just put how many contracts you want to buy, enter your limit order, click confirm, and it'll place it for you. Now, as I told you before, options trade like stocks. They trade it on open exchange. It's all done electronically. And to do that, it needs its own ticker symbol. This Coca-Cola December 2018 $50 call option has a symbol that looks like this. They're all going to start with a period. It's a few elements to it. Now, before I explain this to you, please know you do not have to know how to do this. Okay, you don't need to be able to break this down. It's just when you right-click and hit buy, this is what's going to fill in the form. Also, when you receive buy or sell alerts for the insider report, I'm also going to include this official ticker for that option price. So if you want, you can simply copy it, paste it in your account, and not have to deal with any of this. All right, but here's how this breaks down. The first is the stock's ticker symbol, in our case KO for Coca-Cola. The second two numbers are the expiration year. This is 2018, followed by the expiration month, which is December 12, and then the expiration day. Now, I told you they expire on the third Friday of every month. The third Friday of December 2018 is the 21st. Okay, so Coca-Cola 2018, December 21, when it expires. You with me? Okay, next you're going to have either a C or a P. Not hard to figure out, right? The C stands for call, the P stands for put. Nothing more to it. And then finally, can you guess those last two numbers are? That's right, it's our strike price. So, if you just saw this code, you would say, okay, it's a Coca-Cola $50 call option, and it expires December 21st, 2018. Right? Pretty straightforward. But again, you don't have to do this. You never have to put this in. It's not that complicated. It's not 1984 anymore. But just know this is what's going on behind the scenes. I'm going to give you this if you want to put it into your brokerage account and make things easier for you. But I'd rather teach you too much than not enough. Okay? Now, one final concept I want to be sure you understand when it comes to owning call options. Okay, and it also plays a factor into how we're going to manage our trades. And that concept is something known as time decay. Now, the value of these call options, for the most part, is going to be determined by what happens with that stock price. Right? If the stock goes up a lot, your call is going to go up. If the stock goes down a lot, your call is going to go down. Right? But deep in the background is something known as time decay. Now, here's how it works. If you have an option that doesn't expire for a year, you've got a year to see how high that stock goes. If you have an option that expires in a month, you've only got a month to see how high that thing goes, right? So the one that has a year to expiration is going to be much more valuable than the one that only has a month to expiration. The one that only has 3 weeks and 2 weeks and 1 week. In that last month, the odds of anything positive or big happening in that stock shrink and shrink and shrink and shrink and shrink until it's worthless. And this is what that looks like graphically. So here we have the option value starting at 0 up to $5, $6 per contract or per share per contract. Across the bottom, days to expiration. So we start out 120 days or 4 months out, 90, 60, 30, all the way down to 0 when it expires. And this is what happens at option value if the stock just stayed flat. Okay, if it never moved up or down a penny, it just sat there. This is what would happen to that option value. So in the first, 4 months out, it barely lost anything. The next month, too, it went down a little bit, maybe 2 or 3%. With 2 months left, it kind of made a decent little move, right? You probably lost 15% or so of that value. But look what happens in that final 30 days, that final month. The value just plummets to the downside. Now, the stock's screaming higher, it might be going up, but this is what you got working against you, is the concept of time decay. With less time left until that option expires, there's less and less chance of the stock going higher and a less and less chance of you making any money. So, for this reason, I do not like to own calls that expire in 1 month or less because I don't want to deal with that. I don't want that working against me. So, generally the recommendations in the Insider Report will be for a stock, and I'll include an option play as long as it's optionable, and generally those options will be 4 to 6 to maybe 8 months from expiration. Now, we're going to try to hold those for as long as we can to get a decent move, but when we get down to say 45, 40, 30 days left to expiration, we're going to be looking to get out of those things fast because I don't want to deal with that time decay. So, I just want you to understand that, and it's an important concept because if you're looking at options thinking, well, this January one's only 85 cents while the December one is like $6, well, there's a reason for that. Not much of a chance the stock's going to go anywhere. There's a pretty good shot you're going to lose 85 cents a share. But that's time decay, important concept to understand if you're going to be owning options, and that is why we don't own them in that final month. Okay? Now, a couple of last tips for buying call options I want to leave you with. Number one, as I talked about, always use limit orders. It's too easy to get slippage, get a poor price, things trading like, $2.25. You place buy 10 at the market and you get filled at $3.25 and it costs you $1,000 in slippage. Just use limit orders. Trust me, even if you're going to do it at the high end of that spread, just use a limit so you know you're not paying more than that or you're going to receive at least that. 2, don't chase prices. Okay, if these things can move very fast, they are leveraged. We talked about this already. But if an option is, $2 by $2.25 and you get a thing from me saying, try not to pay more than $3, you open up and boom, the option's at $4. Don't chase it. Don't pay double what we did. Just simply place your limit order at that lower price. If it comes down, it'll fill you. If it doesn't, it's okay. There's going to be another trade. But what you don't want to do is get in a situation where you begin paying more and more and more because you see the thing going up. And then, of course, as soon as you do, it turns around. 3, take partial profits along the way to finance your trades. And here's what I mean by that. And this is what you'll see us do in the Insider Report. If we buy options, let's say we paid $5 a piece for them. Okay, so $500 per contract. 2 weeks later, those things are worth $10 or $1,000. So they're up 100%. Now, we've still got 6 months to expiration. So you could say look at it and say, man, it's done this much in two weeks. I'm going to hold the thing, see what I can do in 6 months. The other side of the coin is this. Don't look a gift horse in the mouth. Okay, you're up 100%. So what we'll generally do is we'll sell half of those. All right? So let me give you an example. Let's say we bought 4 call options for $2 each. Okay? Now, they go up 100%. They double to $4. And so we now sell 2 of those, 2 of the 4, for $4 each. So to get into this trade, we bought 4, and it cost us $800. Right? They're $200 per contract. We bought 4 of them, $800. We sell 2 of them, again at $400 a piece, we receive $800. So now guess what we have? Something known as a free trade. It cost us $800 to get in, we already got our $800 back, and we still have 2 call options left that didn't cost us a penny. So whatever we sell them for is pure profit. So even if they go to 0, we haven't lost money, we got a break-even trade. If they go up and up and up and keep going, we could make a small fortune. So that's what I mean when I say finance your trade. You get up a good chunk, sell some of them, book some profits, protect your initial investment, and then kind of get a free ride going forward. And then finally, only invest what you are comfortable losing. Look, stock options go to 0 all the time. In fact, most of them do, okay? Some people make this mistake. They'll say, all right, I would invest $5,000 in the stock, but I really think it's a good one, so I'm going to buy $5,000 worth of call options. Here's why that's a problem. If it doesn't go up significantly and quickly, you're going to lose all $5,000. If you bought $5,000 worth of stock, it stays flat. You don't think tanks by like 20%, you're down $1,000, not 5. So don't invest a ton of money into options. Don't invest the same amount you would into the stock. So if you would invest $5,000 into the stock, maybe buy 1 or 2 call options for $500 or $1,000, and that's going to be your maximum risk, okay? But that is, for the most part, how you trade stock options. I hope this answers your questions. If not, always feel free to email me, and I'll be glad to help you out in any way I can.